Hello and welcome to NDTV Profit. You're watching The Portfolio Manager, and my guest today is Gurmeet Chadha, who is the Managing Partner and CIO at Complete Circle PMS. Gurmeet, thank you very much for joining us on NDTV Profit. Let's start with the investment thesis that you have. You have two kind of portfolios. One is a core portfolio and the other is satellite portfolio. Take us through the investment thesis for the core portfolio.
Yeah, thank you. Thank you for having me. The portfolio is one. We basically divide the portfolio into two parts, which is core and satellite. At the heart of the metric is, our basic philosophy is growth at reasonable price. We are still largely growth investors, but not at any price. By core portfolio, we mean businesses we want to own for a long period of time. Here, the focus is on ownership of business, where we want to hold the stock for 5, 10, maybe longer years if the investment thesis stands. And here we try to make few times and not just stay 10, 50% return. So I would like to hold some of the names for longer periods of, let's say, 10, 15 years to probably make 10, 15 times over a very long period, rather than just be happy with 10, 15%. We follow three financial filters here, and then there are quality filters. The first financial filter is that the top line should double in 3 to 4 years, which means we are chasing 18, 20% growth. So a lot of the MNCs, some of the PSUs may not make the cut, which generally are good companies, but may not be good from our filter point of view. Any growth in top line should not be at the cost of margins. So margin should be expanding. So let's say, for example, you have Maruti, which used to sell probably 7 lakh cars in 2015. They said they'll end up probably selling 18 lakh units. But the margins have dropped as market has moved from sedan to UVs. Their margins have come to single digits from double digits. So hasn't really resulted in much, let's say, capital appreciation. So are some of the pharma names and so many others, where top line has happened, but margins have been shrinking, hasn't led to any shareholder gain. So any top line growth has to be accompanied by margin expansion. And for the both of two, for sales to grow and margins to grow, the heart of the core DNA has to be innovation. So you should be continuously innovating, and that reflects in the value add you do to the product and services. So again, taking another example, same example, let's say the largest OEMs and supplier of the auto, which is Uno Minda, their kit value per car has gone up from, let's say, 3,000-4,000 rupees to 26,000-27,000 rupees over the last 6-7 years. And it's been more than a 10-bagger. In the same space where auto has gone through slightly rough patch. So the core DNA has to be innovation. This innovation could be in terms of technology, in terms of new products you use, in terms of new processes, backward integration, molecules you develop. So it could be across sectors and not just confined to tech or manufacturing alone. So the core portfolio, and then obviously you have the return ratios to work. This essentially is 80-85%. Part of the portfolio, which we want to hold for a very long period.
So how many stocks would be there in that core portfolio of yours?
Between 14 to 17 stocks, would be, maybe 18 stocks would be part of the core portfolio, which we want to hold for longer period of time.
So when you say that your key themes are BFSI, auto, manufacturing, consumption, and IT, take us through some of the companies or portfolio companies where you see that kind of 10x baggers which are going to come in, because you're going to invest in it but not going to exit for another 10 years. So how are you going to look at it?
So our top themes, so we work on this philosophy is to invest what you know more. I'm essentially a banker. So obviously I like BFSI more, financials more. And we're not restricting here only to banks and NBFCs. We want to play the complete space, which includes private banks, includes NBFCs, include capital market participants, which is, let's say, depositories, RTA agents, exchanges, AMCs, insurance names, right? So it includes other financials as well. So just to give you a few indicators, for example, if you see mortgage to GDP in India is about 11%. That's about 20% for Thailand and about 35% for Malaysia. I'm not even getting into the developed nations. So huge market. The entire mortgage market is just 50 lakh crores, of which 13 lakh crores is between SBI and HDFC. So you'll probably need, more institutions and maybe another HDFC, SBI maybe a dozen more to increase this mortgage penetrations to maybe 25-30% as we go along this decade.
So do you find SBI and HDFC Bank a 10-bagger?
I can't say that everything could be a 10-bagger in this space, but they'll be very steady in this space. But some of the capital market participants, the depositories, the AMCs, the RTAs could be in that 5-10-bagger range. Some of them have already delivered probably that kind of return in last 2 years. But if you take a more longish view, also pretty soon. Look at, for example, the MF total. We just crossed 50 lakh crores. The FD base is 200 lakh crores. So a lot of the growth is very, very structural and secular in this space. So we play through private banks, we play through some of the PSUs, as you rightly said, and through depositories, exchanges, and others.
And in the auto space, you are mainly playing through the allied sector, or is it going to be the OEMs which you're looking at? Because OEMs go through ups and downs in terms of margin based on how various factors impact them.
So, if you see, it's again through we play the entire value chain. So we like PVs more, which is passenger vehicle car more. Again, if you see now, the trend is towards UVs and SUVs. So 2/3 of the cars sold are SUVs. And if you see again the ownership, so number of cars in India, the total cars right now, which meets the safety norms, is about 35 million. This number itself will grow. You'll reach a stage where probably the number of 4-wheelers and 2-wheelers sold will be same 6-7 years from now. So we like M&M and Tata Motors. Tata Motors have been we've been very lucky there. M&M also to a large extent still trades at about 15 times. Then we like as you said, the entire value chain of it. The Uno Mindas, the Sona BLW, the Sandhar Technologies of the world, the KPITs of the world, which are into CASE, which is connected autonomous shared electric, which is the embedded software part of the car. So you want to play that complete chain. In fact, we are of the opinion that the sector has come out after a 4 or 5 year lull. We have very good 4 or 5 years ahead. As far as playing this entire value chain is concerned. And again, we are seeing premiumization here. So that adds to the margin, the second parameter we spoke about, which is expanding margin.
Let's talk about the satellite portfolio of yours, because it's interesting that there the time frame is much lower for you, and whatever profits you earn from there, you plow back into the core portfolio. So how does that work? What kind of how do you select stock for the satellite portfolio?
So just to just spending 30 seconds more on core. So it's BFSI, it's auto, manufacturing. Manufacturing also covers auto to an extent. The fourth one, which we like, is consumption, and premiumization of consumption, which we are seeing, whether it is hotels, whether it is the likes of Tata Consumer, whether it is, the travel Indians are doing. So entire thing comes under that. Satellite portfolio is more tactical. That's basically a special situation portfolio. We want to take advantage of any corporate actions like demerger, change of promoter, any change in regulation which has happened, which can be a tailwind for the sector. So I'll give you an example. Sundaram Clayton got split into 3. You got an auto ancillary, you got the holding company, which is TVS Holdings, and you got a preference share, which was giving you a dividend at around 10%. This happened when the stock was about $4,000. The stock has doubled in last 1 year. Obviously, some of it is because of market. The Sundaram Clayton stock has got listed, which is the ancillary part of it, which now is at about 1,500-1,600, and the preference share is due to mature in Feb. So, just by playing that story, you would have made very handsome returns. Another example is the change of ownership, change of promoter. So one company we bought was Mukund Steel, where Bajaj acquired almost 74% stake from the Shah family. They infused capital, sold a piece of land, almost 1,500 crores came in. The stock was available at about $100 at about 1,100 crore market cap. So it was a no-brainer. Was available at 4 times earnings, and steel was going through an upcycle. So you had the others trading at 15-20 times, and this was available at very low single digit. So we played that. It again has doubled. So some of these examples are there. We went overweight on Reliance because we wanted to have a pie of Geo Financial. So tactically we went in there. So that satellite part for us, where the view is confined to the special situation playing out, and any money made is then, as I said, is plowed back into the core.
Will you consider Geo Financial as a multi-bagger to be held for 10 years?
I would think so, because they would be incubating more businesses, which includes broking, which includes insurance, which includes AMC. This could be something. I mean, I'm not trying to draw any parallels here, but it's something what probably Bajaj Finserv did in the last decade. And with the kind of team they have, they have Hitesh, Mr. Kamath is there as the director. They're stitching together a very, very good team. But it's long drawn. The lending book takes time to build. The insurance and AMC business have very long gestation period. So I agree with you. You've got to have a probably long issue, which is fine.
Plus, there has been some headwinds in the sector.
Sorry, I didn't get the point.
I said there has been some headwinds in the sector for in the NBFC sector for lending, retail lending, and unsecured lending.
No, it's not headwinds. It's just that the regulator wants to be a little more prudent, considering the past experience we have had. RBI data shows some stress in small ticket loans, especially which is less than 50,000. But the quality ones, which are like, let's say, Chola or Bajaj or some of the better names, I don't think so they have any reason to worry.
Typically, what is the timeline for these satellite portfolios that you have?
As I said, the situation playing out, it could vary from 12 to 24 months, maybe a little more. Some of the stories I mentioned just now probably played out within 9 to 12 months. So happy taking some money off there. It also helps you maintain some dry powder for any volatility in the market, because the satellite portfolio would never be more than 15-20% of the portfolio. So it also helps you, especially when markets are trading at where they are, it makes sense to have some dry powder also in the book.
What is the normal level of dry powder that you normally keep?
Yeah, our mandate is not really to be in cash, because when the client gives you money, it's meant for equity. But as I said, we at these levels, because the markets are run up quite a bit, about 5 to 10% cash is something. It's not a huge cash call we are taking, but that's more for any opportunities which may come, for any volatility in the market. And also, I would also say there is some pockets have become very expensive, especially small micro caps, some of the capex, some of the railway, and some of the defense related names. So we want to buy them. It's just that the price is not to our liking. So it helps you probably stay on the sidelines. And mind you, staying on the sidelines also wants you 7-8%. That's what even the fixed income rates are pretty decent these days. So it doesn't hurt you too much.
Gurmeet, hang on there. We'll come back after a short break and discuss this pocket where we're seeing some kind of overvaluation coming in and getting expensive. Stay tuned to the portfolio manager. You're watching NDTV Profit. Welcome back. You're watching The Portfolio Manager on NDTV Profit, and with me is Gurmeet Chadha, who is the managing partner and CIO of Complete Circle PMS. Gurmeet, before the break, you spoke about the fact that there's some sections of the market which is now becoming overheated, or I would say rather than overvalued. Some pockets of small caps. You spoke about defense, and you also spoke about railways coming in. Take us through the small cap pack, because we have seen a big outperformance happening in the small cap and the mid cap sector. How do you see this sector now at this point in time?
So it won't be wise to just paint the entire sector with the same brush that everything is expensive. But yeah, large pockets are expensive. If you see the small cap index, it trades at 26 times earnings, right? Let's say Nifty 21 times, which is I'm talking 1 year forward. Last 1 year return for Nifty is 18 and a half. Small cap index is more than 50% up. And we've seen that in the past that over long periods, which is let's say 8-10 years, the difference is just 1 or 2% between all these indices. And if you remember December 2017, we had a very stellar rally in small cap. In 2018, we saw 20-30% correction without Nifty really having much correction. So the nature of the space is that 10-20% can be gone, and you'll not figure out it will happen so quickly. And we've had some glimpses of that in few days. Just leading up to the state election results and few others. So got to be a little careful. And if you see a lot of portfolio managers are also restricting flows, that tells you that there are some lack of opportunities there. And the valuations, I think some of the way these new IPOs are getting listed, and some of them are trading at 100 times, 150 times earnings without the sector having any strong growth, just that tells you that. So got to be a little careful. And maybe some bit of rebalancing towards large cap may not be a bad idea. Again, not for the entire sector. And some pockets in new age companies where things are turning, but they're still not profitable. The market is probably again extrapolating the current performance. And I see the mistake we do is that we extrapolate what has happened in the last 6-12 months to the future, and that's where you get most things wrong. Also, some of the defense names, some of the orders will get executed over 5-10 years with different milestone payments. I think a lot of the good news is in the price. Some of the railway names, some of the defense names, probably next 5 years, good news is in the price. So you've got to see what is in the price. And similarly, what is more negative. So we saw the things which happened with IT, right? Everything so much negative was in the price that moment you had a very decent number, not a great number, we saw a pullback. So rotation is fast. You got to be careful in terms of how much good news is already in the price.
Do you see some of the companies in the small cap and some sectors that you mentioned, defense or railways, to be multi-bagger in that sense? Because orders are physical here in nature and they have to be delivered in 5 to 10 years. But the way the domestic play is increasing as far as orders are concerned, it's going to be a constant order flow that's going to come into many of the defense companies.
No, I agree. As I said, some of some of it is very structural. So look at defense budget. It's more than 1.7 lakh crores. The government defense production target I'm talking about. That's like a 23% CAGR from FY22 to FY25. And the way, if you see the government capex to GDP, it's an all-time high. Some of it is pretty structural. And again, in defense, you also have indigenization playing out. There are import restrictions. Government has come up with the list. So some pockets are good, especially, pockets like drones, hand grenades, Pinaka rockets, a lot of where the order execution period is slightly lesser. So let's say 2 to 3 years and not like really long drawn. So we like that space. There'll be again companies with backward integration. So for example, one company which has done really well is Titagarh. Earlier they didn't have the ability on the propulsion systems as well as the forging wheels. That was a bit of an impediment. So a lot of backward integration has happened there. And the order book currently, which it has for next 10 year sales, it's 10 times of the current year sales. So there is visibility also there. So not, as I said, not everything is expensive, but a lot of other pockets, a lot of ancillaries, etc., they just run up on expectation that this is how things will be over a period of time. So we've got to be a little more selective, in picking it up. Some of the railway stocks are up 6x last 1 year. That's not sustainable.
Would you have invested in them had you known that they have gone 6x?
Oh, obviously, money has no color. So it's not that. Obviously, in hindsight, some of it is also a missed opportunity. But some of the financing names in PSUs, their NPA classification and asset categorization is different from RBI regulated scheduled commercial banks and NBFCs. So things, can turn ugly if the cycle turns, right? So you got to be a little careful. You can't give the same valuation to a power financial lender and to the HDFC bank, at let's say 2.5 times.
What about IT? Because you have 11 to 12% of portfolio in IT. I think most of the street had written off IT as an underperformer in 2023 and 24. But it seems after the Q3 numbers, there is some rethink happening, and the portfolio is coming back into portfolio of some of the companies. So where do you stand on IT?
So, I think we started increasing IT when prices became more reasonable. There was time when some of the large cap IT names were available at 13 times, 15 times. Case in point being HCL Tech. Great set of numbers. I think, one differentiator in HCL is that it has three businesses, not just the IT services company. There is ERD and there is software. See how the software business has performed. And a lot of their, clients do not have, everything is not discretionary. A lot of it is non-discretionary as well. And that's why, and it was available, when it was about 1,000, 1,100 at about 14, 15 times. Obviously, it's done up 50% from those levels, but very, very well diversified. Good software business, one of the largest ERD players, which is engineering, research and design within IT. So we like that. I think Infi also at some point of time, there was value considering, when it was at 1,300. May not be at the same levels now. So you got to be more selective here. We also got lucky with KPIT and Tata Elxsi to a certain extent. KPIT again is a more, a broader play only on the auto related and embedded software related capex. So it's a mix of, ERD, case, digital engineering companies which we have in IT, and not just typical large and small cap IT. And that's why in this 12% is probably a 4 or 5 stocks, so that we are avoiding some concentration risk in just one particular name.
Are you looking at more of a product oriented IT services company now as compared to a pure services and maintenance company?
The inclination is there, because, but unfortunately, as I said, there are not many choices. One recent IPO which I liked is Tata Technology. It's a very, very good play, and it's from end to end on the auto value chain, starting from design to mechanical engineering to software as well as to the customer service part. Very impressed with the abilities they have. But nothing is going to happen in the next 1 year.
Can that be a multi-bagger in 10 years?
I would put my bets on it, but markets can.
But have you bet on it?
Yes, we have started.
Okay, and so you think that in 10 years it can be a multi-bagger, but interesting that you didn't mention TCS, given the fact that so much of cash is being generated and given back to the investors.
No, we have, as I said, the 12% IT has multiple stocks. So in large cap we have TCS, Infi, and HCL. In mid cap we have KPIT, we have in LT Mindtree is no longer a mid cap. When we bought, it was pre-merger, we had Mindtree. We have some bit of Tata Technology also in the portfolio. It's just a combination, as I said, and we are looking at new ideas as well.
Mm-hmm. Finally, on consumption, you are there in consumption. What kind of consumption play do you like? Is it discretionary as other portfolio managers are liking, or you do bet on some of the staples because it will come back at some point in time?
So we are not really differentiating there. I think what we are focusing on, so we are not focusing on staples much because the growth there will still be single digit, at best high single digit. That doesn't justify the valuations a lot of them trade at. So we will not find a typical HUL, Dabur or Colgate in the portfolio. Nothing against them. It's just that our filter is much higher. They are great companies. We have something like a Tata Consumer where the food business is growing disproportionately. They acquired a company last week. They're getting into new categories, pulses, spices, dry fruits. We play on premiumization there, on your kitchen shelf. Everything you now have on the kitchen shelf is branded, in-home as well as out-of-home consumption. We like some of the jewelry players. We like within, as I said, auto, the SUV guys more. Look at the way real estate is shaping up. All the high-end and the mid-affluent segments are doing well. Look at the way DLF has just delivered on, 2-3 luxurious projects of theirs. Some of the watchmakers. So anything which is upper end, which is related to, the aspirational upper middle class of India is something we are trying to play in consumption, adding a bit of, tourism and religious tourism also.
In all that, Gurmeet, haven't spoken about infra. That's something which is playing out as well, because in the last few years we have seen a lot of infra being built up, and now cash flows are coming in for some of the infra companies. How do you look at the infra as a sector?
So we break it up into two parts. One is bellwether infra, which is the EPC players like L&T, where we look at they gave a tender pipeline which they had of almost 11 lakh crores. That's the best I've seen for a very, very long time with L&T. Then you have the Hyderabad Metro issues getting resolved both on debt as well as ridership. So we like that. We like the power transmission space as well. So if you see, for example, the government is talking of 500 gigawatts of clean energy, which means transmission lines, power transmission lines for 2.5 lakh crores. That's like 25,000 crores every year. So with the kind of power capacity which is likely to get added, the demand for transmission projects, insulators, transformers will be disproportionate. So we're trying to play that with some of the transformer names, transmission names, as well as some of the insulator names.
New energy companies, renewable companies, and
I actually, as I said, I don't do something which I don't understand, because I don't know how the power producing landscape will change. I don't know how much it will be EV, how much will be ethanol. We have some of the names. We have Praj and ethanol, which is biofuel. We have L&T and Reliance, which could be more hydrogen, let's say, the way things are. But as I said, we are focusing more on the value chain in terms of the ancillary, the transmission, the cable wires, the transformers, etc. That's something where we think you can probably plot. See, our job as a portfolio manager is to plot the earnings over the next 5-10 years. In energy production, there are a lot of unknowns there. So you better play where you can plot and where we're reasonably sure of the growth coming.
Gurmeet, it was a pleasure talking to you today on the Portfolio Manager. Thank you very much for joining us on NDTV Profit.